This is part one of a free 3-part mini course for traders. If you'd like to continue receiving these courses, then click the link below and sign up, and I'll send you an email every time a new one comes out. Now, this presentation is not for you if you're perfectly content with losing your money in the stock market. And if you're perfectly fine with making occasional big winners and even fall into some spectacular winning streaks, only to give it all back and then some, then please don't watch this video because it has nothing for you. And it's definitely not for you if you're looking for a promise of a winning trade setup, because frankly, there's no such thing as winning trade setups. So then who is this video for? I mean, this video is for people who want to learn how to stop losing money. And it's for people that when they do make money, they want to know how to keep it in their pocket and in their bank account. It's for people that want to understand what a trading edge is and how to exploit it. And finally, it's for people that have complete reverence for their money, or want to at least develop a sense for reverence for your money, and understand that the market is completely stacked against you, and the only way to approach trading is like a business. It's for people that need and want a step-by-step guide that teaches you only what you need to know. No fluff, just the essentials. A step-by-step guide on how to make a living as a trader. And it doesn't matter if you're a full-time or a part-time trader, or trading to supplement your income, or simply trying to build your wealth. The essentials are all the same. You need to treat your trading like a business. A tough, competitive business, one that requires skill and discipline and an execution plan. You need a step-by-step way to evaluate your plan and continuously improve it. Learn what works and what doesn't, and then adjust to do only the things that work. This is what the step-by-step guide of how to trade Apple for a living is all about. So don't be distracted by the Apple focus. What you're going to learn applies to a wide variety of stocks and securities. In this course, we use Apple as a core holding because it's such a great stock to learn the concepts of the course. It's simply a great stock to trade. Several of the trades in the course are specific to Apple. These trades have incredible profit potential with proven historic performance and return on capital. There's no better way to learn these skills than to start with great strategies that reinforce all the different aspects of the course. Now, this mini course is a scaled down version of the step-by-step Trade Apple for a Living online course. And there are 3 parts to this mini course, 3 big steps. And here they are. Step 1, you develop a foundation, a theory of the markets, and take everything in a business-oriented approach. In step 2, this will be video 2, you execute a plan, your trading strategies, and develop the skill for each one of those strategies and put it all in the context of campaigns. And then video 3, or step 3, you evaluate, reuse what works, and remove what doesn't. Alrighty, this is part 1 in Treat Your Trading Like a Business, the 3-part mini course. So the very first part of part 1 is, and it's the foundation from with which everything else is based, and that is your overall market theory. You kind of think of it like your mission statement for all your trading and all your action and everything that you do. And so you have to have this kind of all-encompassing theory that everything else should fit within so that you're consistent. Now, that doesn't mean that your theory can't change over time or evolve, but generally this is your widest held beliefs and the way the markets work and the way you conduct your business. So here's my market theory. And it's pretty simple and relatively profound. Well, relatively profound, I guess that's a oxymoron. It is very profound. First of all, the market is in constant motion. Without the market being in motion all the time, we have a dead market. If the market was not in motion, you would have, in fact, a dead market. The market needs to be in motion in order for us to profit. The more volatility that there is in the market, the greater the opportunity to profit. Now, that sounds counterintuitive to the way maybe most people think about their trading. They think that there's a lot of volatility, you got to get out of here, it's just going to kill me. But in fact, if there was no volatility, there would be no range in pricing. So it would be very difficult then to set a long or a short and then expect to get any kind of difference in your trade or profit or even loss. It doesn't matter. So you need motion in order to profit. You need volatility. It is absolutely essential. Now, Now, with that, there are essentially two different types of motion in the market. The market is either trending or it's consolidating. And that's all it's really doing. It's either moving really fast from one place to another or hanging out in that one place for a while and just trying to figure out where it wants to go next. I like to think of those areas of consolidation of the areas where traders feel comfortable. They've brought it to that area, they feel comfortable there, and they're going to trade around it. Now, the interesting thing is that 30% of the time you're in trending mode, and 70% of the time you're in consolidation mode. So that should tell you a little bit about the types of opportunities and the types of trades that you might want to put on. So if you're only trending 30% of the time, and those are the only types of trades that you're willing to take, then you're only going to have 30% opportunity, to make a profit. If you have strategies that will work with consolidation modes, then you'll have 70% of the available opportunities to make profit. So it's just a different way of thinking about it. Now, it doesn't necessarily mean that you have to go for the 70 or the 30. It's just a realization that most of the time is spent in consolidation. Now, the other thing is that everything is pretty much random, and you've probably heard of the efficient market hypothesis. And there are cracks in that hypothesis. For the most part, for big players, that is true. And for the most part, most things are random. And because they're random, we can treat them as such and treat them in a probabilistic mentality. So in the very large, things are random. Now, there's also another very important thing, and that is things are also fractal in nature. And what that means is that when we look at the market, we look at it in terms of time frames. You look at it in terms of monthly charts, or weekly or daily. And then we even go down to hourly and 30-minute charts and 10-minute charts. And we might go all the way down to a tick chart. Now, the interesting thing is that in all those different time frames, we see patterns. Whether they are these trending and consolidation patterns, some might call them flags. There are other patterns that get created, like a head and shoulder or a cup and handle, channels. All these things we see in every single time frame. They're just different versions and at different scales. So that's very interesting. So that means that you can develop a strategy, and for the most part, if everything is pretty much random and consistent, then it doesn't matter where you apply that pattern. So that's kind of important when you consider, well, what time frame am I comfortable in trading? The other reason why it's important is that those patterns that you see, they are kind of subservient to the larger time frame. They are within the context of a larger time frame. So you can almost use the larger time frame as sort of your confirmation. So for instance, if the larger time frame is trending up and you're looking at a pattern that is also trending up in a smaller time frame, that's probably going to have a lot more weight than if it were trending in the opposite direction to the larger time frame. So that's what fractal is all about. Okay, so now that we've established that there's opportunity only when the market is in motion, let's talk about where those opportunities lie. And there are two primary places where opportunities lie in the market. A lot of people try to catch the trend, and that is a very, very difficult thing to do. Probably the easiest thing to, now what some people try to do is they try to jump the wave of a trend and then hop onto it. The problem is that you never know when that thing's going to turn around. It's an easier thing to wait for a market to get to extremes and then play those extremes. So opportunity lies in extremes. And the way we term that in a technical analysis point of view is what we call overbought and oversold. When a market moves up very strongly, there are ways of measuring that movement, the volume and the price action, where we find a point where it is considered overbought. And conversely, when it moves down, there is a point where the market becomes oversold. And what we found is that these points also tend to be the points where markets tend to reverse and move the other way. Now, not always. Sometimes you can stay overbought or oversold for an extended period of time, and it can be the frustration of many traders, not really, or catching a move maybe too early or too late. But your opportunity really lies there. There's a greater probability that a market will bounce or reverse when something gets overbought or oversold. So there is opportunity in playing the extremes, and you can play those extremes with either momentum or price. Now, there's also another type of, I guess you could say, extreme, or something that oscillates. I was just talking about how price may oscillate, but you can also measure its momentum, and you can also measure the volatility, the range. And often volatility, the oscillation of volatility is a huge market tell, whether a market is going to be going up or going down or getting weak or getting strong. So again, that all kind of plays into this idea that playing the extremes presents significant market opportunity. All right, now to continue on with the foundational theories, we saw that extremes bring a particular opportunity, and that is that there's a good likelihood that a stock price or price movement may reverse direction when it's overbought or oversold. Now, we don't know when or by how much or any of the critical details. So the next piece is also fits right in with this, and it adds another piece to the puzzle, and it allows us to bring in probabilities into the equation and gain an understanding of where price might be going at any particular time. And so what we're looking at here is a something called a market profile, or a volume by profile diagram. Now, the interesting thing here is that volume and prices are distributed in, well, we said that the market is random, and you would expect that something that is random in nature would produce a standard distribution or a bell curve. And once we have a bell curve, we're at a particular point, and we know that the price distribution from that point on is going to be randomly distributed. We know that there is a first standard deviation, or a 68% chance, and a second standard deviation, or an 84% chance, that price will move within that random distribution a certain amount within those percentages. So in other words, 68% of the time it will move a certain amount, and 84% of the time it will move another certain amount. And we can use techniques like the various options pricing, for instance, or Black-Scholes model, or other techniques to determine what is the chances or the probability opportunity where price might be moving at any particular time. So that is a really a crucial point here. So now, for instance, if we combine this with extremes, and we are at an extreme, then we know with some degree of probability where price may be moving, either up or down. But because we know that we're at an extreme, we can even add that into it and give us a slight edge, in that we can say that there is a better chance that it may move or get skewed in that distribution. And there's a number of other ways that we can apply this random distribution principle, and that is particularly with options and also with volatility as well. So, for instance, implied volatility is a number that we can pull out of just about any kind of trading platform, and implied volatility actually gives us the percentage probability of the next move of a particular price within whatever time frame that you're measuring that implied volatility. So these are, like I said, this is a crucial element, in that now we have a way of assigning a probability to price movement, and then we can use other types of pattern recognitions and other things that we know about trending and consolidation and trend lines and support and resistance in combination with this probability to give us an even better idea, or perhaps even an edge, on which way price may be going. So there we go. There's the next foundational element after extremes. All right, so we've finished up with the foundational elements, although there are other elements that are in the Trade Apple for a Living course. In the interest of brevity and for this mini course, I'm including about half of my total my total theory on markets and the foundational elements. But for this course, it will work just fine. So now I'm going to get on to more business-oriented aspects. The first one is really trying to set some metrics around the performance that you would hope to achieve in your trading. Now, I mean, this is really what it comes all down to. How much money you're going to make, and what is your performance in making that money, and how well are you at leveraging your assets in order to make that money. So there are two terms that I'm going to introduce to you. And these two terms we apply to every single trade and weight every trade based on this. And the reason why we weight it is because these are going to be our primary metrics to determine whether or not a trade is viable and whether or not it fits into our trading campaign, which we'll be talking about in a little bit, and how that adds up. That way, when we put a trade on, we understand exactly what the edge is, and of course we can determine that edge through some of the means that we discussed a little bit earlier about understanding the nature of price movement and where it might be going and what are the probabilities of it moving. Using that all to determine, on each individual trade how well that fits into our bigger plan. So the first term that I'm going to talk about, well, let me introduce both of the terms. They are POP and ROC, and those are acronyms. POP stands for the probability of profit, and ROC, probability of profit, I'm sure you can deduce that is your win rate. What is the expected win rate of any particular trade? And you can use that as a metric for your overall trading account, or you could use it as a metric within a particular campaign, and you would most definitely use it as a metric for any particular strategy and trade. And the second metric is return on capital, and that is another crucial metric that we use in combination, these two things, to determine both our performance and our efficiency in leveraging our capital. All right, so let's look at them in a little bit more detail. As I said, POP is the probability of profit, and ROC is the return on capital. Now, their relationship is inversely proportional. In other words, you can have a very high win rate, and you can construct a trade in such a way that you'll have an extremely high win rate. The problem is that when you do that, you're going to be giving up something. You're giving up a little bit of the volatility that and risk that's associated with that trade. And so consequently, your return, the expected return, should be very small. So your return on capital might be very small. And a good example of this is with, say, an options trade. There are certain types of options trades that you can put on that are extremely deterministic. So, for instance, I could construct an iron condor, for instance, with a very, very, very wide wings, putting the spreads very far out, maybe 5 or 6 strikes on either side. Based on the implied volatility and the price distribution, I could construct a trade that could be, say, 95% win rate. And if I did that trade 100 times, I'd probably come very close to that 95% win rate. The problem is that my profit would be so small that it might not even make up for the cost of putting on the trade, or maybe just a little bit above. But you could, in fact, put on such a trade. Now, the problem with this is that you also exact a huge amount of risk should it go outside of that 95% probability. And that could, in fact, take a lot more trades than maybe even more than 100 to make up for that loss, and the small amounts of wins that you would need to overcome that. So that's an example of the trade-off you may have with POP and ROC. Now, there are metrics that they're kind of standard rule of thumb type of metrics that we like to use. In general, you would like to have a POP, or a probability of profit, somewhere between, say, 60 and 80%. And so it would be good if you could construct all your trades so that they had that kind of probability. And a good rock measure would be somewhere between 25 and 50%. So let's say that you put on an 80% trade and it cost you $200 in margin, then you would be expecting to see about a 50% return on that margin, or about $100. So there would be about an 80% chance that you could make $100. That's just an example, but I mean, you can see now how you would apply pop and rock. Okay, now we're down to a very crucial element of this entire process, and that's the continuous improvement process. And there are a number of technologies and names around this, but I'm going to leave a few with you, and I'm not going to go into it in great detail because it really is an expansive topic, and I go into it in excruciating detail. Well, I shouldn't say excruciating, but really a lot of information. There's actually 3 parts to this this whole thing within the Trade Apple for a Living course. And what I'm going to show you here is just a sliver of the first part. So it's really crucial part of your trading where you're continually improving what you do, and you have a very specific process that you lay down, and it actually, although it sounds complex at the outset, it's actually quite the opposite. And in fact, the continuous improvement process that we're going to be using is something called Kanban, and I encourage you to go look that up. And I'll also include with the course some materials that will help you get an understanding of what Kanban is and some of the other methods that we use within the course to help manage our time and also evaluate our trades and our whole process and just make it much more efficient. But let me just say this, that Kanban and also the concept of Kaizen, Kaizen means good change, was originally developed within the Toyota manufacturing. And it's actually the reason why Toyota was able to become the premier and number 1 car manufacturer in the world. Their ability to be able to reduce defects and improve their overall process and get the time from the time a car starts on one end of the assembly line to the other, and reduce that down to something that was unimaginable for any other type of manufacturer out there. And now here's the real interesting thing, is that Apple employs a lot of these same principles in Kanban and also Kaizen and lean manufacturing. So that it's all kind of part of this genre, and it's all part of this sort of Zen-like minimalistic attitude towards your trading. And it's what I said right from the very beginning. This cuts out all the fluff and just concentrates on the things that are essential. So let me leave it with that and say that, this is probably one of the most crucial parts, but it's also one of the things that is the most expansive in the course. And I encourage you to go look at Personal Kanban. There's actually a site called personalkanban.com, I believe. And I'll leave you with some references and so forth. So that does it for the first of 3 of our mini course for how to treat trading like a business. Now, there are other parts that I could go into as well in terms of treating your trading like a business, in terms of setting yourself up as a corporation, the benefits of that, your entire layout and the inventory of equipment that you would use, setting up for disaster recovery, and all kinds of other things that I cover in the course that are just too much and too expansive to include in a free mini course like this. But the fact that I just mentioned it gives you an idea of the overall depth and breadth of the course itself. All right, so there you go. There's part 1 of our 3-part mini series. The next part, we're going to start talking about campaigns, although in this part I said I would talk a little bit about campaigns. I'm going to make it a focal point of the next module, or part 2. And we're going to talk about creating campaigns, creating strategies, and I'll actually introduce a strategy that perhaps one of our best trades in the course, and I'm going to be giving it away to you. So make sure that you signed up. Get a friend to sign up as well for this course, and get them to watch this video first, obviously, and make sure that you don't miss part number 2, because it's going to be crucial. It's going to be taking a lot of the things that we learned here in terms of foundational strategies and then putting them together into some new concepts that I'm going to introduce called campaign trading. Thank you very much. See you next time.